8 killer strategies to outsmart tax bracket creep and keep your money. Imagine getting a raise only to find out you're taking home less money. Sounds crazy, right? Well, thanks to our old friend Tax Bracket Creep, it's a reality for millions. But don't worry, I've got your back with 8 genius strategies to keep more of your hard-earned cash where it belongs, in your pocket. Tax Bracket Creep is like that sneaky friend who always manages to grab the bigger slice of pizza. As your income rises with inflation, you might find yourself in a higher tax bracket, paying more than your fair share. But not after today's video. Before we dive in, hit that subscribe button and notification bell. Trust me, your wallet will thank you later. Let's break it down. Tax bracket creep happens when inflation pushes your income into a higher tax bracket. Sure, you're earning more, but you're also paying a higher percentage in taxes. It's like running on a treadmill. You're moving, but not getting anywhere. The government adjusts tax brackets yearly, but many credits, deductions, and exemptions stay the same. Result? You could end up with a higher effective tax rate, whether you're itemizing or taking the standard deduction. Strategy 1. Maximize retirement contributions. First up, let's talk retirement. It's not just about your golden years, it's a goldmine for tax savings right now. For 2024, you can contribute up to $23,000 to your 401k. That's $23,000 you're not paying taxes on this year. And if you're 50 or older, throw in an extra $7,500. That's like finding money in your couch cushions, but better. Now let's break down the math. If you're in the 24% tax bracket, maxing out your 401k could save you $5,520 in taxes this year alone. That's a nice vacation or a serious dent in your debt. But wait, there's more. Let's not forget about IRAs. You can stash away $7,000 plus an extra grand if you're 50 plus. But here's where it gets juicy. Your deduction might vary based on your income and whether you have a workplace plan. Do you know your IRA deduction limit? Pause the video and take a guess. Got it? Let's see if you're right. If you're single and covered by a workplace plan, you get the full deduction if your income is $77,000 or less. It phases out completely at $87,000. Married? Your full deduction limit is $123,000, phasing out at $143,000. Not covered by a workplace plan? You might be in for a treat. Single filers can deduct their full contribution at any income level. Married filers can do the same unless their spouse is covered by a workplace plan, in which case the deduction starts phasing out at $230,000. Pro tip: if you can't deduct your traditional IRA contribution, consider a backdoor Roth IRA. It's a bit complex, but it could save you thousands in taxes down the road. If these tax-saving tips are blowing your mind, smash that subscribe button now. We're just getting started, and you won't want to miss what's coming next. Strategy 2. Health Savings Account Hack. Next up, the unsung hero of tax savings, the Health Savings Account, or HSA. If you have a high-deductible health plan, an HSA is like finding a cheat code in the game of taxes. For 2024, individuals can contribute $4,150, and families can sock away $8,300. Over 55, add another $1,000 to that. But here's the kicker. HSAs offer a triple tax advantage. Your contributions are tax-deductible. In the 24% bracket, that's a potential $1,292 tax saving for families. The money grows tax-free. Invest it wisely and you're looking at serious tax-free growth. You can withdraw it tax-free for qualified medical expenses. Now or in 40 years, it doesn't matter. Here's a pro move. Pay medical expenses out of pocket now, keep your receipts, and let your HSA grow. Years down the line, you can reimburse yourself tax-free. It's like a time machine for tax savings. And get this, after 65, you can withdraw HSA funds for any reason without penalty. You'll pay income tax, sure, but it's essentially transformed into an extra retirement account. Strategy 3. The art of income deferral. Sometimes the best defense is a good defense. Enter income deferral. Did you sell a house? Get a fat severance check? Or maybe you're killing it with your side hustle. If this extra income might push you into a higher tax bracket, consider postponing the payout until next year. Let's break it down with an example. Say you're married, filing jointly, and your taxable income is $190,000. You're in the 24% bracket, but that big year-end bonus of $50,000 would push you into the 32% bracket. By deferring just $10,000 of that bonus to next year, you could save $800 in taxes. This strategy is especially powerful if you expect to be in a lower tax bracket next year. It's like telling the taxman, not today, buddy. For home sales, remember you can exclude up to $250,000 of gains, $500,000 for married couples, if you've lived in the home for 2 out of the last 5 years. That's a chunk of change you get to keep. But wait, there's more. Did you know that capital improvements to your home can increase your cost basis. That new roof or kitchen remodel, it could reduce your taxable gain when you sell. Keep those receipts. How much can a married couple exclude from their home sale gains? Shout it out loud. Strategy 4. The Roth conversion magic trick. Now let's pull a rabbit out of the hat with a Roth conversion. Yes, converting your traditional IRA to a Roth means paying taxes now, but it's like ripping off a band-aid. A little pain now for a lot of gain later. Here's why it's magical. No required minimum distributions, RMDs. Traditional IRAs force you to start withdrawing at 73. Roths, never. Tax-free growth. Every penny of growth is yours to keep. Tax-free withdrawals. In retirement, you won't pay a dime in taxes on qualified withdrawals. But when should you do it? Consider converting when you're in a lower tax bracket than you expect to be in retirement. You have a year with unusually low income. You have losses in your taxable accounts to offset the conversion income. Pro tip: convert just enough to fill up your current tax bracket. This maximizes your conversion without pushing you into a higher bracket. If these strategies are saving you money already, don't forget to subscribe. We've got 4 more game-changing tactics coming up, and you won't want to miss them. Strategy 5. Tax loss harvesting. Let's turn those market lemons into tax lemonade with tax loss harvesting. When the market takes a dip, don't just sit there. Harvest those losses. You can use them to offset gains and even deduct up to $3,000 against your ordinary income. Here's how it works. Identify investments that have decreased in value. Sell them to realize the loss. Use the loss to offset capital gains or up to $3,000 of ordinary income. Reinvest the proceeds in a similar but not identical investment. For example, let's say you have $10,000 in long-term capital gains this year. You also have a stock that's down $8,000. By selling that stock, you can reduce your taxable gains to just $2,000. In the 24% bracket, you just saved $1,220 in taxes. Here's the pro move. Sell the losing investment and buy a similar but not identical one. This way, you stay in the market while locking in that tax benefit. It's like having your cake and eating it too. Just be careful of the wash sale rule. Don't buy back the same or a substantially identical security within 30 days. The IRS is watching. Strategy 6. Asset Location Mastery. Now let's play chess with your portfolio through smart asset location. Think of your investment accounts like different types of soil. Some plants, investments, grow better in certain soils. Accounts. Here's how to master asset location. Put tax-inefficient investments in tax-advantaged accounts. Bonds and bond funds, which generate taxable interest. REITs, which pay non-qualified dividends. Actively managed funds with high turnover. Keep tax-efficient investments in taxable accounts. Index funds and ETFs. Low turnover, qualified dividends. Individual stocks you plan to hold long-term. Municipal bonds, tax-free interest. Let's look at an example. Say you have $100,000 in bonds yielding 4% and $100,000 in a stock index fund returning 7% annually. By putting the bonds in your IRA and the stocks in your taxable account, you could save over $1,000 in taxes each year. Bonus tip: if you need to sell from your taxable account, prioritize lots with the highest cost basis to minimize capital gains. It's like giving each of your investments its own perfect home. Your portfolio will thank you. Strategy 7. Qualified charitable distributions. For our retirees out there, here's a way to be generous and tax smart at the same time. If you're 71, 2 or older, you can donate up to $105,000 directly from your IRA to charity. This counts towards your required minimum distribution but doesn't increase your taxable income. Here's why it's brilliant. You satisfy your RMD without increasing your taxable income. You support your favorite causes. You might reduce your Medicare premiums, which are based on your taxable income. You could stay in a lower tax bracket. Let's crunch some numbers. Say your RMD is $20,000 and you regularly donate $10,000 to charity. By making a $10,000 QCD, your taxable RMD is now only $10,000. In the 22% bracket, you just saved $2,200 in taxes. You still get to support your favorite cause. It's like killing 2 birds with 1 stone. You satisfy your RMD and support your favorite cause, all while keeping Uncle Sam's hands off your money. Can you name one charity you'd support with a QCD? Shout it out. Strategy 8. Supercharge your charitable giving. Finally, let's talk about turbocharging your charitable contributions. Consider bunching your donations. Instead of giving a little each year, give a larger amount every other year. This might push you over the standard deduction threshold, maximizing your tax benefit. Here's an example. Standard deduction for 2024, married filing jointly, $29,200. Your typical itemized deductions without charity, $20,000. Your typical charitable giving, $5,000 per year. By bunching 2 years of donations, $10,000 into 1 year. Year 1, itemized deductions of $30,000, $20,000 plus $10,000. Year 2, take the standard deduction of $29,200. Total deductions over 2 years, $59,200. Compare this to giving $5,000 each year and always taking the standard deduction, $58,400 over 2 years. You just increased your deductions by $800. Or look into donor-advised funds. You get the tax deduction now but can spread out your giving over time. It's like a time machine for your charitable giving. And don't forget, you can donate appreciated assets. You get to deduct the full market value and avoid capital gains tax. It's a win-win-win. All right. Let's recap our 8 killer strategies. Maximize retirement contributions. Leverage health savings accounts. Master the art of income deferral. Consider Roth conversions. Harvest your tax losses. Perfect your asset location. Use qualified charitable distributions. Supercharge your charitable giving. Remember, tax planning is a year-round sport. Start implementing these strategies now, and you'll be ahead of the game when tax season rolls around. If you found this video helpful, you're going to love our deep dive into 5 common tax mistakes to avoid. It's the perfect companion to today's strategies. Check it out right after this video. Hungry for more money-saving tips? I've got 2 exciting videos in the pipeline, and I want you to choose which one we produce next. Option 1. The ultimate guide to tax-efficient investing. We'll explore how to structure your portfolio to minimize your tax bill while maximizing your returns. Option 2. Retirement tax strategies. Pay less, keep more. Discover how to optimize your retirement accounts and withdrawals to slash your tax bill in your golden years. Which one do you want to see first? Leave a comment below with your vote. If this video saved you even $1 in taxes, smash that like button and share it with a friend. Remember, knowledge is power, but applied knowledge is money in the bank. Have a tax strategy that's worked wonders for you? Drop it in the comments below. Let's build a community of savvy tax planners. And if you haven't already, now's the perfect time to hit that subscribe button. We're on a mission to make personal finance accessible and actionable, and we'd love to have you along for the ride. Until next time, keep growing that wealth.